You've probably seen SCHD popping up on every dividend-focused watch list. But lately, it's been acting a little weak. Today, we're diving into exactly what's happening with SCHD, why the weakness isn't necessarily a reason to panic. Let's start with the basics. SCHD is the Schwab US Dividend Equity ETF, tracking quality dividend-paying companies. It focuses on sustainability, strong cash flows, and consistent dividend history. This fund has been a favorite for conservative and income-seeking investors with competitive yields. Historically, it's shown stability even during market turbulence, compared to other dividend ETFs like VYM and DGRO. Interest rates play a huge role in investment decisions. When rates rise, bond yields rise, making a 3% dividend less attractive. Investors rotate out of dividend-paying equities into fixed income for guaranteed income. This behavior is classic capital flow. With the Fed hinting at a pause or cut in rates, analysts are watching SCHD closely. When rates stabilize, dividend ETFs regain favor. CHD has been priced at a premium due to its reliability. However, this premium has compressed, entering a favorable zone. Due to its fundamental strength, this pullback can be a strategic buying opportunity rather than a warning sign for investors. CHD is heavily weighted towards sectors like consumer staples, healthcare, industrials, and financials, which often perform well in uncertain markets. People still need groceries, medicines, and essential services during inflation, meaning SCHD's underlying companies are resilient. Scheme for companies with a history of dividend growth and strong financial health to ensure dividend sustainability. Investors can rely on SCHD for reliable income, as it's unlikely to cut its dividends even if prices dip temporarily. Weakness in the market offers a chance to accumulate SCHD at better prices, appealing for consistent returns and steady income. The best dividend investors buy when others are fearful, maximizing long-term growth potential. The ETF currently yields around 3.5%, which is above some broader market averages, but lower than extreme outliers like REIT-focused funds. The beauty of SCHD isn't just the yield, it's the combination of yield and stability. Year over year, the dividend growth rate has been around 8 to 9%. For anyone reinvesting dividends, that's a compounding machine in motion. CHD is primarily US focused, but many of its companies have international revenue streams, which adds diversification. CHD has weathered recessions, rate hikes, and volatility, showing consistency that matters more than chasing the latest tech IPO. At the end of the day, dividends compound, and that compounding drives real financial freedom. CHD is structured to minimize capital gains distributions, making it tax efficient for taxable accounts. Don't overlook this advantage. By reinvesting dividends in a brokerage account, you're allowing tax efficiency to enhance your portfolio growth while minimizing disruptions. Set realistic expectations. CHD is not a get-rich-quick ETF. It's a long-term wealth builder best purchased over time. Consider dollar cost averaging, which smooths entry points and reduces emotional reactions to market volatility, enhancing investment stability. Compare SCHD to ETFs like VYM and DGRO. SCHD offers reliability and growth, making it a favorite for both new and seasoned investors. Weakness in a solid ETF like SCHD often triggers fear. Investors see it dropping and start questioning everything. Experienced investors know that temporary underperformance doesn't erase decades of growth potential. Focus on fundamentals, not headlines. Companies that generate cash, pay dividends, and grow earnings will eventually be rewarded by the market. SCHD gives access to these companies. Understand why it's weak, recognize long-term value, and consider using weakness as a chance to accumulate. Dividend ETFs like SCHD aren't about daily price action. They're about building a consistent income stream. Consider starting small, reinvesting every dividend and holding with patience. Compounding beats hype. Remember, SCHD isn't just an ETF. It's a tool for financial freedom, if played smart and stayed disciplined. Always do your own research. Consider your financial situation and invest in a way that aligns with your goals. CHD offers a blend of income stability and long-term growth that's hard to beat. Be consistent, patient, and strategic. CHD's focus on quality companies with strong cash flows positions it well for long-term success. Its commitment to dividend growth and stability makes it a compelling choice for income-focused investors. Analysts expect that as interest rates stabilize, SCHD could start to outperform it then. Its emphasis on companies with solid fundamentals means consistent dividend payments for, particularly retirees. By automatically reinvesting dividends, investors can take advantage of compounding over time, significantly boosting total returns during flat price periods. This strategy helps mitigate short-term price fluctuations and focuses on long-term growth. CHD's low expense ratio makes it more efficient compared to actively managed funds, retaining more income for investors. The importance of diversification within SCHD cannot be overlooked, with over 100 holdings spanning multiple sectors. This reduces single-sector risk while providing exposure to a variety of industries, cushioning against downturns. For investors valuing growth potential and income stability, CHD can be an attractive portfolio addition. Many long-term investors continue to hold and reinvest dividends despite short-term fluctuations, which supports the fund's stability. Those who panic during market dips often miss the power of compounding dividends over time. Keeping a disciplined approach and focusing on the fund's long-term prospects is critical. Remember, SCHD is not necessarily a quick profit vehicle. It's designed for steady growth and income generation. If you found this deep dive helpful and want to stay updated on all things dividend ETFs and long-term investment strategies, make sure to hit that subscribe button. Share your thoughts in the comments. Are you currently invested in SCHD, or are you considering adding it to your portfolio? Stay informed, stay patient, and watch your investments grow steadily over time. Many investors focus too heavily on short-term price fluctuations. But dip in the market makes them panic, thinking the fund is weak. CHD isn't built for quick wins. It's designed to weather storms while steadily paying dividends. Those dips are often opportunities. Many companies in SCHD are household names with strong balance sheets and a track record of dividend growth. They have survived multiple market cycles. One powerful tool with SCHD is dividend reinvestment. Every payment can be reinvested into additional shares, building a compounding effect. Reinvesting allows you to buy more shares at lower prices, accelerating growth when the market rebounds. It can turn a modest investment into a substantial portfolio. Another important aspect to consider is SCHD's sector diversification. It has strong holdings in sectors like technology, healthcare, and consumer staples. It doesn't rely on any single sector to carry performance. If one sector faces a downturn, the fund remains resilient. For example, if energy prices drop, the fund is offset by the performance of sectors like technology or industrials. This broad exposure is a key reason why SCHD has been able to consistently pay dividends, even during challenging market conditions. Looking back over the last decade, the fund has maintained a steady track record of dividend payments, even during market crises. Unlike riskier high-yield funds, SCHD prioritizes sustainable income, focused on companies with a history of increasing dividends. Market sentiment can swing wildly based on economic news, interest rates, or geopolitical concerns. It's normal to see short-term underperformance compared to other funds. CHD's strength isn't in chasing short-term trends. It's in consistency, income generation, and long-term capital appreciation. Periods of underperformance can actually present an opportunity to invest more at discounted prices, leading to higher yields on reinvested dividends. CHD's low expense ratio means more of your investment stays in the fund, compounding over time and enhancing performance. The difference between a low-fee fund like SCHD and a high-fee alternative can amount to hundreds of thousands of dollars in lost growth over decades. CHD's resilience comes from its emphasis on quality over flashiness. It doesn't chase the hottest sectors or unsustainable yields. Instead, it focuses on companies with strong fundamentals, consistent earnings, and a history of rewarding shareholders. This approach might feel slow compared to high-risk, high-reward alternatives, but this discipline allows SCHD to...
What if the Federal Reserve had kept interest rates at 5.25% during the 2008 financial crisis instead of cutting them to near zero? The banking system would have collapsed within weeks. With borrowing costs still sky-high, major banks couldn't access emergency funding. Credit markets froze completely as businesses couldn't afford loans at those rates. Unemployment wouldn't have peaked at 10%, it would have shot past 20%. Housing prices didn't just drop 30%, they crashed 70% as foreclosures exploded. But here's where it gets really terrifying. The dollar became so strong it destroyed every export industry overnight. Deflation spiraled out of control as consumers delayed purchases, expecting prices to keep falling. Foreign countries panicked and dumped treasury bonds, creating a government funding crisis. The entire global financial system began collapsing within months. What started as monetary policy would have triggered a depression worse than the 1930s. One decision could have ended the modern economy as we know it.
The Federal Reserve made a pivotal move in financial history, impacting every corner of the economy. Stocks, bonds, real estate, commodities, everything is about to be affected. But for smart investors, moments like this are opportunities. The Fed's latest announcement marks a major turning point in monetary policy, ending the era of higher for longer. Inflation has cooled, unemployment is ticking up, and debt delinquencies are rising, signaling a potential slowdown. The Fed's balance sheet remains huge. Policymakers are balancing growth with avoiding another inflation surge. Investors who understand policy shifts will thrive as capital rotates from old winners to new ones. The Fed funds rate sits around 5.25%, but the forward markets are now pricing in 2 to 3 cuts within the next year. Bond yields are already falling, signaling the market believes tightening has peaked. This is bullish for rate-sensitive sectors like tech and real estate. but also creates major opportunities in fixed income ETFs. You need to think in terms of positioning rather than prediction. This is the perfect environment to rebalance toward quality, yield, and growth resilience. The first ETF to watch closely is the Vanguard Dividend Appreciation ETF, VIG. This fund focuses on companies with a consistent record of increasing dividends year after year. The iShares Core U.S. Aggregate Bond ETF is gaining attention. Bonds are back, and those who dismissed fixed income may miss out on significant gains. With yields near 15-year highs and the Fed indicating rate cuts, bond prices are set to rise. AGG offers exposure to the entire U.S. bond market in one package. Next, consider the Invesco QQQ ETF. Tech isn't fading, it's evolving with AI, cloud computing, and digital innovation leading the charge. Lower yields boost growth stock valuations, benefiting QQQ. Top holdings include Nvidia, Apple, and Amazon, making it ideal for long-term growth. Lastly, the Schwab U.S. Dividend Equity ETF combines high yields with low volatility. It's perfect for income and stability amidst market shifts. The fifth ETF that could shine is the iShares MSCI Emerging Markets ETF, EEM. Global liquidity improves with the Fed's monetary easing, often fueling rallies in emerging markets. Emerging markets like China, India, and Brazil could gain from a weaker dollar and improving trade flows. Historically, they perform best when the Fed eases. The Fed's pivot reshapes investor psychology. Markets were conditioned to fear rate hikes. Now, cautious optimism is returning. The next bull market will be broader, more value-driven, and yield-conscious. Understanding ETF allocation is crucial. ETFs like VIG, SCHD, and QQQ provide steady cash flow and growth. AGG locks in yield, while EEM offers global diversification for a weakening dollar. Timing still matters. The market loves to price in expectations early, so the best buying window may have already passed. Investors are repositioning now before the policy shift becomes official. Don't react to headlines. Be ahead of them. Inflation could reemerge if energy prices spike. Maintaining diversification is key, including exposure to commodities. Corporate earnings are crucial to watch. Rate cuts boost valuations but can't fix declining profits. The Fed's pivot changes capital flows. A weaker dollar supports commodities and foreign equities. Some analysts argue that inflation is not truly defeated and that the Fed's shift could backfire. That's a valid concern. The structural differences in today's economy make a repeat of the 1970s unlikely. Investors should keep an eye on real rates and inflation expectations. The Fed's decision marks the start of a new phase, not the end of uncertainty. Market cycles reward those who adapt early. ETF strategies that thrive during rate hikes are changing. Long-term bonds, dividend stocks, and selective growth plays are now favored. Start by reviewing your portfolio's duration risk and yield exposure. Shifting part of that capital into AGG or intermediate-term bond ETFs is critical. Rotating from speculative growth stocks into dividend growers can stabilize returns as rates fall. This is an ideal moment to consider dollar cost averaging into ETFs that are still undervalued. QQQ remains pricey, but SCHD and VIG offer a more attractive entry point. The market often overreacts in transitions like this, creating short-term dislocations that savvy investors can exploit. As 2025 unfolds, expect the conversation to shift from how high will rates go to how fast will they fall. It's a classic rotation play, and ETFs offer the simplest and most efficient way to capture it. If you've been waiting for clarity from the Fed, this is it. The fog is lifting and the direction is set. When Powell speaks about inflation and employment, it's not just economists listening. It's regular investors and everyone with a stake in the economy. That signal says, change is here. The Fed is redefining how much pain or growth the economy can withstand. Rate cuts are now a tool for recalibration, not just emergencies. Bond yields are cooling, housing prices stabilizing, and the labor market is loosening just enough to ease inflation pressure. The stock market anticipates 6 months ahead. As the Fed hints at easing, money begins to rotate before policies are enacted. ETFs offer broad exposure and reduced volatility for smart investors looking toward growth. As the Fed signals easing, growth-focused ETFs like QQQ or VUG are surging. Cheaper money revives innovation across sectors. Market confidence is as fragile as it is powerful. Investors have lived in fear of rate hikes, hard landings, and persistent inflation. With the Fed's tone softening, investors shift from survival mode to optimism, fueling bull markets and leading them to buy and hold. This optimism isn't reckless. The scars from previous years have made investors smarter, focusing on quality over speculation. They look for dividend yield, cash flow, low expense ratios, and long-term sustainability. ETFs are leading the inflows again. The Fed's pivot may mark the end of one of the toughest investment climates. Inflation is trending lower, and GDP growth remains positive. The smartest investors know that markets turn when fear is high. The Fed's shift confirms many suspicions. The worst may already be behind us. Now, the big question: what ETFs actually thrive in this type of environment? We've got 5 strong contenders, each representing a different piece of the post-pivot puzzle. Some capture dividends and stability. Others tap into growth and innovation, and a few ride the global rebound. Together, they form a portfolio designed for what's coming next. Think of it like building a bridge across uncertainty. On one side is the old, high-rate, defensive market. On the other side is the emerging era of re-expansion. The key isn't guessing what the Fed might do next. It's positioning yourself for what the market will do once it already knows. We're seeing a fascinating new trend. Retail investors acting more like institutions, layering positions and dollar-cost averaging into diversified ETFs. Those who understand macroeconomics know that rate shifts are time bombs of opportunity. ETFs give investors exposure to that momentum. And that's why so many experts are calling this the ETF decade. Central banks in Europe and Asia are aligning policies, hinting at synchronized easing, amplifying liquidity, and boosting equity valuations. Investors who ignore this alignment might miss the biggest global rally since the post-pandemic recovery. Inflation could reemerge, geopolitical risks could flare up, and rate cuts might not come as quickly as expected. Balanced ETFs diversify across uncertainty, cushioning market corrections with dividends while capturing growth in rallies. Pension funds and sovereign wealth funds are rotating from cash-heavy holdings into equities and credit ETFs with massive inflows. We're witnessing a generational opportunity. The Fed shift signals a reset in sentiment and a return of long-term capital to the markets. When we talk about the Fed changing everything, it's not hyperbole. It's a system-wide reset. We're stepping into a cycle where growth, technology, dividends, and global trade all start breathing again. The smartest investors aren't waiting for news. They're positioning through diversified ETF exposure. The beauty of the ETF era is flexibility. You build layers of exposure and protect your downside. The Fed's pivot could spark a multi-year bull cycle driven by innovation, infrastructure spending, and renewed credit expansion. ETFs tracking sectors like clean energy, semiconductor manufacturing, and healthcare innovation could outperform the broader market. AI and automation are transforming every industry. Investors can seize this with ETFs like BOTZ, ARK, or SOX. Rate cuts amplify investment in innovation and growth. This feedback loop makes the next cycle powerful. ETFs like SCHD, VYM, and DVY offer consistent income while benefiting from rising equity valuations. In a lower rate environment, dividend yields are more attractive compared to bond returns. Long-term investors enjoy moderate risk, wide diversification, and multiple avenues of return. The Fed's actions set the stage, but investors must act before the crowd. Timing is crucial. When people say the Fed changed everything, it's a window of opportunity that rewards strategy and patience. The market doesn't reward emotion, it rewards perspective. Right now, the perspective is shifting from fear to focus. ETFs are the modern vehicle of that focus. They provide access to the market's core growth engines while spreading risk. The Fed's move changed interest rates and redefined the playing field. Don't sit still. Plan, diversify, and position. History is repeating. The last time we saw a similar setup, markets rallied for nearly a decade. Will you be positioned? The shifting landscape of global markets has intensified the appeal of thematic ETFs aligned with long-term changes. Investors are seeking relevance with funds tied to AI, renewable energy, cybersecurity, and infrastructure. These trends benefit from Federal Reserve policy. When liquidity expands and the cost of capital drops, innovation thrives. Investors who enter early can ride years of compounded growth. There's a renewed focus on international diversification. Emerging markets and frontier economies often present unique opportunities. ETFs tracking India, Indonesia, and Brazil are drawing attention due to improving fiscal stability and younger demographics. The challenge is balancing risk and reward while global inflation shows divergence and commodities re-enter the growth cycle. The Fed's shift reshapes how the world allocates capital, making geographical diversification through ETFs more critical than ever. Be early, be informed, and most importantly, be disciplined. Don't fight the Fed, but understand it. If you found this breakdown helpful, hit that like button, subscribe for more insights, and share your thoughts on your next ETF purchase.